$74 billion vanished in slow motion, and the world barely saw it coming. One energy company rose on hype, secret deals, and slick pitch decks, then collapsed like a paper city when light hit its books. Imagine this was your pension, your savings, your child's college fund. Would you have spotted the warning signs in time? Tonight we go inside the Enron collapse, the fraud that rewrote corporate rules and exposed a culture where profit theater beat truth. But there is more to uncover, and the trail starts with the story of how the dream was built. It looked like a miracle of innovation. Revenues rose quarter after quarter, while risks hid behind exotic names. The question is simple: who built the illusion, and why did watchdogs miss it? Enron was born in 1985 from a merger of Houston Natural Gas and Internorth. Kenneth Lay became the public face, a polished advocate for free markets and light touch rules. Jeffrey Skilling pushed a vision of asset-light energy trading instead of pipes and plants. Andrew Fastow, a young finance star, learned how to fund that vision away from the balance sheet. Regulators praised innovation, while the company charmed analysts with bold targets and smooth earnings. From early on, a critical choice shaped the numbers that you saw. The company won approval to use mark-to-market accounting in 1992. That method let Enron book today the profits it expected to earn over many years. If a project looked profitable on day one, income appeared immediately, even if cash would arrive later. Quarterly calls sounded like magic shows, where the reveal always met the script. Then came the internet boom and deregulation waves across power and gas markets. Enron leaned into complexity with contracts, derivatives, and structured deals that few outsiders understood. In 1999, the firm launched Enron Online, a trading platform that aimed to be the marketplace for energy. Reported revenue grew to the tens of billions, yet real margins stayed thin, so the pressure to deliver never eased. Inside, managers learned that missing a target could end a career, and that fear fed the next risk. Culture made the engine run faster than the truth. Rank and yank reviews pitted teams against one another and rewarded short-term wins. Salespeople locked in deals that paid on paper, while engineers struggled to build projects that matched the promise. Your savings could have vanished if your fund bought the hype and ignored the strains. But to see how the story broke, you first need to see how the scheme worked day to day, line by line. The shine came with quiet compromises that bit. Arthur Andersen earned consulting fees while signing off on complex reports. The board approved intricate financing that reduced reported debt but raised real risk. The Securities and Exchange Commission relied on disclosures that looked complete, yet key details hid in footnotes. In California, market strain hinted that the model might be profitable for traders and painful for customers. Here is how the numbers stayed shiny while the core weakened. Step 1 was mark-to-market timing. A project signed today could be valued at the profit management expected over many years. If the forecast was rosy, earnings appeared now, and questions could be handled later. Shortfalls on cash would be explained as timing, and belief carried the story forward. Step 2 was moving risk to special purpose entities that looked independent but were not truly independent. Andrew Fastow helped set up vehicles with names like LJM and the Raptors. Those entities borrowed money and bought troubled assets from Enron at prices that protected reported profit. On paper, debt and losses moved out. In practice, guarantees and hedges were tied back to Enron stock, so the risk never left the house. Step 3 was conflict. Fastow served as chief financial officer while also running LJM, so he sat on both sides of many deals. The board granted conflict waivers, and fees flowed to the manager. Internal critics warned about structure and exposure, yet momentum and targets ruled the day. Would you trust a trade where the referee owned the team and set the clock? Step 4 was asset parking and round-trip movement. If a venture missed targets, an entity could buy it at quarter end to lock in paper gains. Later, the asset might return under a different label with fresh estimates and a new plan. Each move created the appearance of progress while hiding the true cash impact. This pattern built a tower of deals that depended on stable stock and patient lenders. Step 5 was financing that looked like trading. Prepay structures, raised billions of dollars from banks, but flowed through trading desks as if they were simple commodity deals. That treatment made borrowings look like operating cash rather than debt. Credit ratings stayed high for longer, and analysts focused on growth stories instead of liquidity stress. Step 6 was cultural pressure that punished doubt. Employees learned that hard questions ended careers, while yes answers unlocked bonuses and prestige. Reports were polished for the next call. The cycle rewarded presentation over truth and pushed teams to find yet another structure to meet the line. Finally, step 7 was the hedge illusion. Enron claimed that risky assets were hedged by the Raptors. The hedges relied on the value of Enron shares and related notes. When the share price held, the protection looked strong. When the share price slipped, the hedges dissolved and losses rushed back through the front door. The playbook spread into other lines. In broadband, capacity swaps and forecasts produced gains without matching cash. Footnotes grew thicker and clarity faded. Analysts loved smooth earnings even as volatility hid under structure. It did not break in one dramatic moment. It snapped piece by piece as confidence slipped, and the scaffolding gave way. In the summer of 2001, a finance executive named Sharon Watkins warned Kenneth Lay in a detailed memo. She described accounting landmines tied to the Raptors and to related party activity. Inside the firm, debate flickered, but the public story still promised strength. Markets had started to doubt the miracle. Shares drifted down as the tech bubble burst, and as the energy markets grew more cautious. With a lower share price, the hedges weakened, and the same protection that once looked strong began to fail. Banks pressed for clarity about the special purpose entities and about the true cash position. That pressure met a habit of delay, and patience thinned quickly. In October of 2001, the company announced a large charge tied to the unwinding of those entities. A restatement followed that cut past profits and added debt back onto the balance sheet. The Securities and Exchange Commission opened an inquiry, and analysts who once cheered began to reverse course. Would you have held your shares while each revision revealed that yesterday's truth had been staged? A possible rescue appeared when Dynagi agreed to a merger. The idea looked neat on paper, yet due diligence exposed holes in liquidity and trust. As new details surfaced, the ratings agencies downgraded credit and collateral demands surged. Traders saw smoke and pulled away. A run had started and it would not stop. Arthur Andersen, the auditor, faced its own crisis. News broke that staff had shredded documents as the heat rose, a choice that destroyed remaining confidence. The Justice Department stepped in and partners fled. By late November, the rescue died. On the 2nd of December, Enron filed for bankruptcy, at the time the largest in United States history. Thousands like you lost savings in pension funds that had loaded up on the stock. Employees watched retirement accounts shrink as lockups kept them from selling. The dream turned to wreckage, and the companies that had cheered stepped back. The question had become unavoidable. What exactly was real, and what had only looked real because the light was dim? That reckoning began now. Rules would never be the same. The collapse became a template for modern corporate failure. Enron filed in early December, and more than 20,000 employees faced layoffs and benefit cuts. Pension plans and index funds absorbed heavy losses as the share price fell toward pennies. Thousands like you watched long-term plans shrink, and trust in markets cracked. Prosecutors and regulators moved. Andrew Fastow pled guilty to fraud and served time. Jeffrey Skilling was convicted on multiple counts and received a long sentence. Kenneth Lay was found guilty, but died before sentencing. Arthur Andersen was convicted of obstruction, later reversed on appeal, yet the firm collapsed as clients fled. In Washington, the response reshaped rules. The Sarbanes-Oxley Act of 2002 required chief executives and chief financial officers to certify reports. It tightened auditor independence, created the Public Company Accounting Oversight Board, and raised penalties for fraud. Accounting guidance on special entities was strengthened so that guarantees and control drove consolidation. Risk oversight and independent directors gained real teeth. Markets also changed habits. Investors demanded clearer cash flow and plain reports on hedges and guarantees. Analysts pressed on related party deals. Boards began to tie pay to long-term metrics and to claw back bonuses after restatements. Banks paid settlements, while the Securities and Exchange Commission set new enforcement benchmarks. Follow cash. Earnings are promises, cash is proof. Check whether operating cash rises with profit and reject repeat scripts. Check incentives. If pay prizes smooth quarters, teams will smooth results. Prefer plans tied to long horizons with clawbacks. Watch related parties. If hedges or vehicles linked to insiders, risk returns. Require clear control and collateral. Beware complexity. If safety needs layers, it may be theater. Ask for plain words on how money is made and kept now. Strengthen gatekeepers. Auditor independence and strong audit committees matter. Regulators set rules, but you refuse unclear reports. If you want to see more financial scandals exposed, subscribe to Money Mystery. Share this video to warn more people. Which scandal should I investigate next?